So last class we had discussed about the topic of, I was giving you more specific step by step of how to make the financial statements, the profit and loss statements as well as the balance sheets, right? And we had seen some of these seven processes are there, and I was just giving a very brief explanation. Again, we will not go into too detail of the technicality, but I'll show you some examples so that these steps will become clearer for you, right? And in that we had already covered the initiation, writing in a chronological manner. Rest everything we are still looking at. And in that I had introduced you this principle of double accounting, which is essentially the debit and the credit related discussion, that for any debit there has to be an equal value credit entry in your accounts. And by account I mean here, it's not, balance sheet is not an account, profit and loss statement is not an account, those are financial statements. In that, type of asset could be an account. For example, cash could be one form of a account within the company, right? That's for financing term. It's not or it's an accounting term. It's not the typical bank account that we were referring to, right? And in that we had this kind of a convention that we were discussing, that if your account is of asset type, an increase in this would be on the debit side, while a decrease in this would be on the credit side. Similarly, if your account is of the liability type, an increase in liability goes to the credit side, but a decrease in liability goes to the debit side. And then we had expenses and income, and this is what I was explaining. The expenses, increase in expenses goes to the debit side, decrease in expenses goes to the credit side, increase in income goes to the credit side, and decrease in income goes to the debit side. Any questions in this part? This is where we left the last class. Is this convention clear to you now? So far we have finished the two steps. The third step was making adjustment entries, right? What happens is, so typically all the other transactions, the cash transactions, the ledger, the journal kind of entries that we have seen so far, they are recorded for each and every transaction. And in a company, there could be hundreds of transactions in a day, right? So you do not close all, or you do not make aggregated statements every time you update a transaction, right? So typically you have some sort of a fixed period that, okay, every week or every 2 weeks, I will transfer all these entries to financial statements. In that time, you need to first make adjustment entries. So adjustment entries are more or less like, they are not recurring on a daily basis kind of a thing. These happen like a once in some sort of a frequency. And then you also need to close these individual accounts that you have opened for each of those periods. So then you finally can transfer the balance to your main profit and loss and balance sheet statements, right? So transactions such as wages to be paid to the laborers and the depreciation in the fixed asset are not recorded on a daily basis, right? So that's one of the issues, because each transaction happens at a different frequency, and therefore an appropriate entry is made only at the time of preparing financial statements such as the balance sheet, profit and loss accounts and stuff like that. So you do not record them every day. Typically you record them only when you need to close the account statement and you need to prepare the final balance sheet or whatever, right? So these entries are known as adjustment entries, are made in the journal only at the time of closing these accounts. By closing these accounts, I mean that, let's say you had for a period you wanted to, like a week long transactions you recorded, and then you wanted to transfer all these entries to the balance sheet. At that time, you will close all these small accounts that we have seen, asset type and all. You will close them for a week duration and transfer the balance to the main balance sheet account in like an aggregated manner, essentially. That's what I mean by closing the account. At that time, you make these adjustment entries also, right? These are all these, again, I'm not expecting you to remember what it is, but you know the concept essentially. These are not occurring on a daily basis. These occur over some fixed period of time, and therefore only when you make the financial statements final, you create these entries and then close the accounts. Okay. Then once you have prepared all these adjustment entries, you prepare transaction in something called a T account or a ledger. I know, very boring. Takes me also time to come back to this zone, but essentially this is just a formal introduction of the concept, that is, right? So as and when the entries in cash book and journal become substantial in number, they are posted in relevant T accounts. Why T accounts? Because apparently this is in the shape of a T account, which I don't understand where exactly is this, but apparently this is a T. This is how they try to make me understand. I'm just giving you a visual. I don't see the T, but it's called a T account. Okay. For some organizations, posting may be done on a daily basis, while for some it is on a weekly basis. So that again really depends upon what is the nature of your business. It could be that in a day you are having so many transactions that you need to do this exercise every day. But essentially whatever other entries that we made so far, these were kind of preliminary entries. But T ledger is a more formal. T ledger is kind of a pakka khata, you could say. So whatever mistakes you make in your ledgers and journals and all. But T account, you try to have a more clean and well-refined statement so that it is easy to refer to every time, right? In a ledger, the debit entries are recorded on the left-hand side and the credit entries are recorded on the right-hand side. And accordingly, these are like, you will see how to put that. And this is, for example, the building assets related T account will look like this. If your building increases by, let's say, 1 lakh rupees, the reference, because we are following the reference, C1 is the cash, journal is the J, T is the T transaction, 1 is the number, building amount increases by 100,000 kind of thing, right? Okay. So once you have created, even in your T account, you have sufficient number of entries, then you try to do a closing of this account and transfer the balance to the financial statements. I will show you a detailed example of that also later, but here is the process. So each of the T account or ledger mentioned earlier is closed at the time of preparing the initial trial balance, which is the prerequisite for preparing the financial statement, which is the profit and loss accounts as well as the balance sheet. So after you put entries in T ledger, you prepare something called the initial trial balance. At that time, you further consolidate all these entries, double check all the errors and everything. If the debits and credits are matching, then only you transfer them to the final financial statement, which is a P&L statement or your debit, the balance sheet, right? And in this case, once you close this T account, there is some activity called carried over. I will show you the example later. Okay, don't get frustrated about so many terms. These are not important as such, but what we will learn of how to simplistically understand this. But I will not expect you to make a full balance sheet. But if you want, I will give you a exercise. If this is something that excites you or it interests you, I will give you a proper exercise with a solved example, and you can refer to that and make your concepts clear, right? And again, if you have doubts there, I will still help you out, no problem. So initially, when you have to prepare a profit and loss account, and then you need to close the T accounts. So the trial balance becomes the source and basis for preparing the profit and loss account for a period and balance sheet of any date. For preparing profit and loss account from the trial balance, you put the items related to revenues and expenditure, you put them into the P&L, and the rest everything goes into the balance sheet. Okay, let me show you the process rather here again in a more simplistic manner. Your transaction gets initiated, simple, easy to understand. You have some sort of a proof that this transaction happened, and you give that proof to the auditors or accountants. You need to put initial entries either in a cash account or a non-cash account. In that, you just put them in a chronological manner. You transfer, you then make adjustment entries which are not happening on a daily basis or a periodic basis. Only when you need to do the analysis of final financial statements, you make these adjustment entries. Through this adjustment entries and the data from the journal and the cash book, all that goes into something called a T ledger, right? That T ledger, you need to then, that's a more formal accounting process. You need to also close that T ledger to create something called a initial trial balance. I'll show you that also. In initial trial balance, some of the entries are related to your profit and loss. These are related to your revenue and expenditure. So those entries goes directly to the profit and loss statement. and then the information in profit and loss and the remaining information from T ledger goes to prepare the final balance sheet. Okay, so it's nothing too complicated. It's just that there is so much text to it that we have to first understand. Okay, and I'll show you simple examples on how to deal with these transactions. At least you will be able to understand the financial statements of a company. In the previous slides, I had shown you an example. You remember we did a minor exercise of P&L statement and balance sheet. Before that, there were few list of transactions that I had given you, 9-10 transactions I had given you. That essentially is a initial trial balance statement. Using that, you pick some of them related to revenue and expenditure and put in your profit and loss statement. Remaining, everything goes into the balance sheet. Okay? All right. So let me show you some interesting examples. Yeah, and then this is essentially finally preparing the balance sheet. So preparation of the final trial balance sheet precedes the preparation of balance sheet as on a particular date for a company. The final trial balance includes items related to assets and liabilities from the initial trial balance and balances of profit and loss accounts. So some entries from the trial balance directly goes to your balance sheet, and the net effect of the P&L also goes to your balance sheet is what I'm trying to say. Okay. All right. Let's learn all this in a informal manner. Again, do not claim that you know accounting after going through this next set of 2-3 lectures. It is just for your understanding of the financial statements, how these things happen. And this is based on a very fantastic book. This is a book by 2 of IIM Ahmedabad professors. It's called Accounting Made Easy. Amazing book, 200 pages book. Just feels like a story, and it just goes away to show a lot of interesting examples. We will take examples from there also to look at in an informal manner. Okay, but this is not a formal. Do not put a CV point that you know accounting or you are a CFA level 1 cleared. All that thing is not going to happen. Don't claim all those things. Okay, this is just for your informal understanding. All right. So, little bit of a story. Rohit is my first master student, so I am trying to make him famous. He's now in IIM Ahmedabad, so that also connects. But essentially, after graduating from IIT Madras, Rohit wanted to start a construction company. Not true. At that time, that was the hope. He wanted to start with the trading first, and he had been saving some money every month from his scholarship. Again, not true. Rohit got his degree on June 30th. This is true. He got his degree on June 30th, right? So this is just a content, trying to make it a story. Of course, you could always see the boring numbers. That's not the point. So the first transaction, what happens is Rohit is founding a company called ABC Trading Company. Okay. So on July 1, Rohit withdrew 1 lakh rupee from his bank and announced the formation of the ABC Trading Company with this amount as the initial capital. So what Rohit did was took 1 lakh rupee from his personal bank, made a company called ABC and transferred that money to ABC company. We are making all these statements not from Rohit's perspective. We are making these statements from ABC company's perspective. Okay. So for ABC company, this is essentially what? Initial capital, right? And a cash influx. There is a 100,000 rupees that came into ABC company's account, and there is a capital that has put into it, right? So how this transaction looks like in balance sheet on July 1. Again, you never make entries directly on balance sheet. Okay, so this is fundamentally wrong. What I am showing you is fundamentally wrong compared to what I have discussed so far. This is just for your informal understanding. Okay, if this entry were to reflect on your balance sheet, how would it affect the balance sheet? You have typically in balance sheet, you have an assets as well as liabilities. You typically follow the order of increasing order of liquidity, right? Right now there is nothing, and here again this is not a format of preparing a balance sheet either. This is just for your simplified understanding. I am trying to give you a transaction wise understanding of how the balance sheet would reflect this kind of transactions, right? So what happens in July 1? cash opening is 0 because the company just started. But 1 lakh rupee has come into company's bank account. So the cash, which is an asset, increases by 1 lakh rupee. Your closing balance becomes 1 lakh rupee. Total of assets is 1 lakh rupee. What is the liability? Because company borrowed money, this is the initial capital that Rohit invested. Company cannot keep this money on his own. Ultimately, company has a responsibility to pay back its original investors. Therefore, the capital is shown as a liability. The liability is also increased by 100,000 rupees. The total balance of liabilities is 100,000. The total assets and liability sum is equal. Make sense? Easy entry, easy to understand what's happening. I was talking about a lot of these T ledger and kind of things. So I'm also giving you a very detailed example. We'll then go over more different type of transactions. The capital account is a liability type account, right? What is happening in a liability? It is increasing. Increase in liability goes on debit side or credit side? Credit side? Pakka. Because I have written here, or you know the convention, or you understand the convention. Essentially, increase in liability goes on the credit side. That's the convention we are following here. This will always follow you. Increase in liability goes on the credit side, right? So, this T1 statement, whatever that transaction 1 happened, you will refer to on a credit side in the T ledger, which is your capital accounts T ledger, right? Capital accounts T ledger we're talking about. Some small description that this was cash and 100,000 amount. An equivalent debit entry has to be there in overall company's account, not within the capital account. In overall company's account, there has to be an equivalent debit entry. What is debit? Cash. Cash is an asset. Increase in asset goes on debit side. That comes here. The total debit and credit is same, right? This principle is sacrosanct. You cannot break this principle of debits equal to credits. This is the fundamentals on which accounting works. You have to, and this is the way how do they check, cross check if things are matching or not matching. If you check just the balances of debit credit in each statement, you will immediately know which statement has a problem and you will be able to pinpoint issues where exactly these entries are not matching. Okay? This is simple, easy to understand. So, transaction 2. Just when Rohit was about to start trading, his seniors told, of course the seniors, told that he was being terribly old-fashioned. How could he run business without a bank loan? Right? Which is not a bad advice from seniors, surprisingly, but still. So on July 2, Rohit went to the bank feeling a little nervous, but the bank manager recognized him. Did not happen in reality. You are the recipient of the President's Medal into this year. The nation is proud of you. No bank manager tells you that. Don't worry about that. If you want, we will give you 50,000 rupees and here is the cash. Okay? Our door is always open you if you want more. This statement definitely not true from any bank's perspective. Okay? But essentially what happened is 50,000 rupees of loan he got. Right? So, what's happening to the company's balance sheet? What were the assets originally? Cash, not 1 lakh. What were the assets? Cash. Is there an increase in cash asset? By how much? 50,000. Is there an increase in capital that Rohit invested? Is it increase in capital or company's loan? Yeah, it's not Rohit's money. There is a difference in loan versus capital influx, right? Capital influx is the high risk capital. If the company goes bankrupt, they do not have a first say. The first say is always for the loan. Bank gets the first say to repay its loan. If the bank sees that your company is going to default, they'll sell your assets. Rohit's influx does not get a priority when distributing the profits or losses. In losses, yes. In profits, no. The bank first receives its share back. That's called something called a debt and equity. You might have heard this term, debt to equity ratio and all. Company needs to balance that. Typically, high equity is not good because then the cost expectations are high, but too much debt is also not good. So there has to be some sort of a balance between them. We are not going into that, but essentially, I'm just showing you the transaction. So cash original balance was 1 lakh rupee. This transaction affected 50,000 rupees plus. So the total becomes 1 lakh 50 at the end of day 2, which is July 2 in this case, right? Liability side, capital still remains same, no change in capital. This one, the bank loan actually should come like this. Right? There is a new liability head created. Essentially, that's a new liability account being created for the company. There is a plus 50,000, 150, 150. Assets and liabilities are equal. Making sense? Okay. What are the accounts, T ledger accounts? Asset side, which account? Cash. There is an increase in asset, goes on debit side. What are the new? Is there any change in the capital account? Capital is a liability account, but there is no change. Bank loan, another liability account. Increase in liability goes on credit side. Debit and credit equal, sum should match. This is shown here. Your T1 cash 1 lakh, no change in your liability account of cash. No, capital. The asset type account of cash, there is a second transaction, bank loan worth of 50,000. It is on debit side. An equivalent entry to the credit side is on bank loan, which is a liability type account, T2 cash 50,000. Total debits equal total credits. So far with me? Okay. Interested in Rohit's story? More of Rohit's story? Alright. So July 3, Rohit bought a small shop building for 25,000 rupees, paying cash to pleasant surprise of the seller. Which is, yes, it is a pleasant surprise of the seller that he immediately paid all the 25,000 rupees. His seniors in the municipality helped him to register the building purchase quickly. Seniors are important. Don't pay attention to all their advices, but yeah, they are important. And they registered this asset in the ABC company's trading name, right? So what has happened? Which assets got affected of the company? Cash depleted. Any other change in liability? Any other asset getting affected? Shop building. Building is an asset. So, but is there any change in liability? Yeah. So you are right. There is a new asset being created. Originally it was 0 plus 25,000. The closing balance is 25,000. Cash was 150. It got subtracted by 25,000. The new cash is 125,000. Total assets still remain 150. No change in the liability. This is what I mean that assets are convertible. You can change one form of asset to another form of asset. Typically, you have shifted from less liquid to high liquid to less liquidity. Because now building is not so easy to sell and all those things. Cash was of course the most liquid form of asset, right? But there is no change in liability because of this. Cool. T ledger. Is there any new T ledger that you need to open? What is the name? Building. What type? Asset type. Is there an increase in asset? Goes to which side? Debit. Where is the other equivalent credit entry? Cash. Cash is what? Asset. Decrease in asset goes to debit and credit. Matching? Clear? So essentially, your capital liability, no change. This was the transaction, no change. Your cash as an asset, there is a new entry T3 on the credit side because there is a decrease in asset, it goes on the credit side. worth of 25,000 rupees. Bank loan, no change. Building account is asset type. Increase in asset goes on debit side. An equivalent entry. Sum of debits, sum of credits always equal. Okay. Transaction 4. Given his lack of experience, Rohit decided to make a small start. On July 4, he bought 10,000 rupees worth of cement as usual, paying by cash. What happens? Cash changes, goes up or down? Down by 10,000. Is there a new form of asset being created? What is it? Cement, like basically your stock. Cement, you don't show cement as an asset. Stock is an asset. Stock is a more generic term accounting wise. Any changes in liability? Alright, so all of you are correct. So building 25,000, no change. Stock, you saw earlier the building just came above cash, but now stock is more liquid compared to the building. So you have to maintain that order of liquidity always. Stock increases by 10,000, 10,000. Cash depletes. Originally it was 125,000. Again a 10,000 decline. It becomes 1,15,000. Total assets still 150. Total liabilities still 150. Right? You need to open a new T account. What is that? Stock. What is its type? Asset. Increase in asset. Debit. Cash account. Decrease in asset goes to credit side. Debit credit matching. Right? Same exact thing. Just walking you faster. But essentially, this is what we have done. Okay? So far with me? Alright. Transaction 5. Fortune favored Rohit, which is also did not happen in real world. But on 4th evening, the government decontrolled cement. This is not David, this is Rohit. Suddenly David appeared, which is not correct. Rohit promptly sold his entire stock of cement on July 5 for 12,000 rupees for cash. Okay. So he had some cement bags, he sold them for 12,000 rupees. Any change in assets? Which assets got changed? Cash, increase or decrease? Any other asset? Increase or decrease? Okay. Any change in liability? You want to say something? Profit is there. So the liability has to change because now company is making 2,000 rupees profit in this transaction. They can't keep this for themselves. This ultimately belongs to Rohit as a capital investor. So there is an increase in liability as well. Otherwise, you will have assets worth of 1,52,000, but liability is only worth of 1,50,000. Right? Because you have sold for 12,000, stock depletion is of 10,000, cash influx is of 12,000. So where is that remaining 2,000 coming for? So that goes into the liability side also. So there is an equivalent entry into asset and liability. Your stock decreases by 10,000, becomes 0. Your cash increases by 12,000. The total becomes 127. This whole thing becomes 152,000. It was originally 150,000. So this is called retained earnings, which is essentially the profits that you have not paid to your stakeholders. That is the retained earning that creates a new entry gets created and it shows 2,000 rupees. Why I am not showing it immediately in capital? It's not been distributed yet. Rohit had an option either to reinvest this in the business, maybe buy new form of assets and things like that, or at some period it defines that, okay, I will give some money back to my original stakeholders. So till that time that does not happen, this retained earning remains in a separate account in the company. Make sense? Okay. T ledger. Bank loan gets increases its value. or you are paying it from current assets. So it depends upon where you are exactly doing that. But yeah, interest gets accumulated in the liability essentially. This book has all the cases that you have doubts about. Alright, so this is where we'll stop. We'll start from this particular case from tomorrow.